Welcome to The Explainer. Today, we're throwing on our analyst hats and running Ellington Financial, ticker EFC, through the ultimate stock gauntlet. We're going to take their latest financials and filter them through the legendary minds of Warren Buffett, Benjamin Graham, Peter Lynch, alongside some rigorous mathematical models. We want to find out, is this high-yield stock a hidden gem or is it just a value trap? Let's get right into it.
Here's our roadmap for the gauntlet. We'll start with a quick company snapshot, apply the Buffett and Graham lenses, shift over to the Peter Lynch view, run a strict DCF model, explore some alternative methodologies, and then tie it all together with a final recommendation.
Kicking things off with Section 1, EFC Company Snapshot, decoding the diversified financial asset investor. Before we start modeling, we really need to know what we're looking at.
What's fascinating about EFC is just the sheer breadth of what they actually do. They aren't just buying one type of mortgage. They're a truly diversified financial asset investor. We're talking residential and commercial loans, asset-backed securities, reverse mortgages, consumer loans, the whole shebang. And looking at their Q1 2026 earnings, they posted a really solid GAAP net income of 78 cents per share. So right out of the gate, they're proving this diversification can actually weather market volatility.
To anchor our analysis, let's look at the core metrics pulled straight from the data. EFC is currently trading at $13.68, which is right around its book value per share of $13.56. For the quarter, it's generating adjusted distributable earnings, we'll call that ADE, of 55 cents per share. Oh, and it pays out a massive $1.57 annual dividend. Keep these baseline numbers in the back of your mind, because they're going to be the fuel for all our upcoming models.
Moving into Section 2, Buffett and Graham lenses, the value investor stress test. We're stepping into the shoes of the ultimate value guys, hunting for that economic note, consistent earnings, and a rock-solid margin of safety.
So Warren Buffett loves to use owner earnings to figure out the actual cash a business generates for its owners. But, with a financial firm like EFC, working capital and mortgages fluctuate so wildly that traditional free cash flow gets super messy. To fix that, we're assuming EFC's adjusted distributable earnings, that 55 cents per share, is our proxy for owner cash flow. Annualize that, and you see some highly consistent earning power, so it passes Buffett's initial test, even though he'd probably raise an eyebrow at their somewhat complex debt structure.
Next up, how does EFC stack up against Benjamin Graham's strict defensive investor checklist? Well, it actually checks off a lot of boxes. Adequate size? Yes. Proven earning stability? Check. An uninterrupted dividend record? Absolutely. But crucially, Graham demands moderate pricing. With a forward PE of just 7.06 and a price-to-book hovering right around 1.0, EFC passes Graham's pricing test with flying colors.
Now, this next part brilliantly illustrates the power of Graham's methodology. If we plug FNC's projected annual EPS of $1.94, along with its $13.56 book value, into Benjamin Graham's famous intrinsic value formula, the square root of 22.5 times EPS times book value per share, it spits out a massive target of $24.33.
Let's compare that intrinsic value calculation to the current share price. The contrast is stark, folks. The stock trades at $13.68, but Graham's math is telling us it's worth $24.33. That implies a roughly 43% margin of safety. For any deep value investor strictly following Graham's rules, this is literally a massive green flag.
All right, Section 3, the Peter Lynch lens, growth, price, and category. Let's completely pivot from deep value to a growth at a reasonable price mindset.
Lynch famously categorized companies, so he knew exactly what to expect from them. Now, he definitely wouldn't call EFC a fast grower. Instead, he'd probably label it a stalwart because of that steady dividend, or maybe an asset play. Why? Because its true value really lies in its massive, diversified portfolio of credit assets that are trading right around book value. Let's run Lynch's absolute favorite metric, the PEG ratio. That's simply the PE divided by the growth rate. If we take EFC's forward PE of 7.06 and divide it by their projected EPS growth of 4.24%, we land on a PEG ratio of 1.66. Since Lynch considers a PEG of 1.0 to be fairly valued, that 1.66 signals that, from a pure earnings growth perspective, the stock might actually be slightly overvalued. In his specific framework, that's leaning toward a hold or a sell. But Lynch always taught investors to look under the hood, right? While our source data doesn't highlight insider buying, Lynch would absolutely dissect this credit portfolio breakdown. He'd zero in on their heavy reliance on non-QM loans, which make up over 46% of their credit portfolio, to fuel that massive yield. He'd respect the underlying asset base, for sure, but he'd probably remain pretty cautious about the growth trajectory that PEG ratio just warned us about.
Moving on to Section 4, DCF Valuation Model, Forecasting Future Cash Flows. Now we're stepping away from the qualitative guru frameworks and diving into rigorous, absolute math.
Because EFC is a highly leveraged financial company, traditional free cash flow just doesn't work perfectly. So we're assuming a base case DCF built on free cash flow to equity. We're plugging in a very conservative 2% terminal growth rate to reflect long-term inflation. And since specific betas weren't provided in the data, we're discounting it back at a 9 to 10% weighted average cost of capital, which is pretty standard for the industry.
When we run those numbers, our baseline DCF model spits out a fair value per share of $14.75. What's really cool is that this aligns almost perfectly with the consensus analyst price target from our source data. For you as an investor, this represents a solid 7.8% upside from where the stock is currently trading.
Now, this table brilliantly illustrates the nuance of financial modeling. It shows exactly how tweaking our assumptions changes that fair value. Look closely at the bottom row. Even in a highly conservative scenario where we demand a strict 10% WACC and assume only 1.5% perpetual growth, the math still spits out $13.80. That is above the current trading price. So the DCF math strongly suggests the stock is currently sitting in undervalued territory.
Let's look at Section 5, Alternative Valuation Models, DDM, and Comparable PE Multiples. A true analyst never relies on just one or two models, so let's run EFC through two alternative frameworks to see if our theories actually hold water.
First up, the dividend discount model, or DDM. Because EFC functions largely to pass on high yields to shareholders, kind of like a REIT structure, valuing that dividend stream is absolutely crucial. With a rock-solid $1.57 annual payout and projected forward dividend growth of 0.55%, the DDM heavily supports a buy rating. Honestly, that reliable cash return places a really hard floor under the stock price.
Second, let's look at a comparable company analysis using PE multiples. While our source data doesn't list direct competitors by name, we know that a forward PE of 7.06 is remarkably cheap compared to broader financial industry averages, which usually hang out in the low to mid-teens. So this relative valuation model is once again flashing a signal for potential undervaluation.
And finally, Section 6, Synthesis and Final Recommendation, the ultimate verdict. We've officially run the gauntlet. Now it's time to bring all these diverse, rigorous frameworks together into a single, comprehensive verdict on Ellington Financial.
Our master summary table reveals a pretty powerful consensus, with one notable exception. Graham's formula screams strong buy, thanks to that massive margin of safety at $24.33. Our math-heavy DCF model also points to a buy with a 14.75 target. However, Lynch's growth-focused PEG ratio is the contrarian here, urging caution and signaling a hold or sell because the earnings growth just isn't fast enough to justify a higher multiple in his specific view.
Blending all these insights together, the investment case really hinges on weighing the massive strengths against the glaring risks. The strengths, they're undeniable. Management delivered a huge 26% annualized economic return in Q1, and that dividend yield is real, tangible cash in your pocket. But the risk? Well, you're going to have to stomach a total debt-to-equity ratio of 9.0 to 1. Now, even though the recourse debt is a much safer 1.9 to 1, that overall leverage is something Warren Buffett would definitely scrutinize.
Ultimately, at $13.68, our synthesized rating lands as a cautious buy for income and deep value investors, totally driven by Graham's margin of safety and that DCF floor. But what do you think? Is Ellington Financial a brilliantly diversified value masterpiece just hiding in plain sight? Or is that 9 to 1 debt ratio making it a high-yield trap just waiting to spring? Dig into the data, weigh the frameworks, and decide for yourself.